6 months ago, we were in a very different position than we're in today. And we were, in fact, worried about probably more supply on the market. But things have got a bit tighter. Tell us what's going on the last few months.
Well, since the beginning of the year, we've seen some relatively positive growth around the world. The U.S. first quarter was weak, but in general, we see that GDP growth this year is likely to be around 1.9%. Eurozone's likely to grow around 1%. And what you're going to see is out of China, you'll see 7.5%. Global economy between 3 and 3.5%. What all that means is those are all pretty good numbers. They're all positive, unlike the Eurozone for the last 2 years. So you're seeing all major economies moving in the right direction, and that's going to be positive for oil demand growth.
Indeed, some analysts that I've spoken to disagree a little bit in terms of like the growth. But as you said too, it's small, but the fact that it's going in the right direction, this is ultimately what everybody wants to see, isn't it?
Well, that's right. I mean, this is modest growth. You're moving in the right direction. For a number of years, I know we've done these interviews, and I've been saying that the outlook for the U.S. is one where you're getting rich slowly, right? And that's been the outlook of modest growth in the U.S. And here we are. We've had a number of highs again and again and again in the equity markets. And so the getting rich slowly prospect of growth mounting and mounting does turn into real growth at some point. And so that's something for the global economy as well. We see modest growth moving forward. You really only run risks of recession if you have very, very strong growth that can overheat. We don't see that for several years.
Let's take a look at the Chinese economy, and again, some area that we've really been dependent on in many ways for global oil demand growth. Now cooling off a little bit, but again, even with the IMF and the World Bank, they're coming up with different figures, but both still over 7% without a doubt, maybe even above 7.5%. That's still pretty good. What would you say?
Well, I think for China, the thing is you're seeing positive oil demand growth really coming from an emerging middle class. And that's going to continue to increase and grow. Whether you see Chinese growth at 6.5 or 8.5 or anywhere in between, it doesn't really matter because that growth is going to continue. If you look at any of OPEC's numbers, they're looking at 87% of the demand growth through 2035 globally for oil demand. That's going to come out of China, India, and emerging Asia. That's a trend that's not going away. Year over year, you're going to see record numbers of auto sales, more oil demand growth year after year. That's very positive for oil demand, and that's supportive of oil prices.
So here we are, the middle half of the year. Prices have been rather stable, not a whole lot of volatility in the market. Brent keeping up there about 110, and even what we're looking at, WTI about 105. So things are actually looking pretty good in terms of that stability. This, of course, must be what the producers particularly want.
Well, it has been very stable this year. Our outlook going into it was that we would see prices very likely similar to last year. Currently, our forecast is a little bit higher than $108, which is very close to what we had last year, and a range of $95 to $115 for most of the year. We've seen that it is stabilizing for producers, for consumers. It's also less worrisome on the inflation side of things, so they're not worried about things heating up because you've got a relatively stable price.
When we look at the Q3 and Q4, what are your expectations in that sense? And we're looking at the recent figures coming from the International Energy Agency and really looking at the call on OPEC to increase. The ceiling has been around the 30 million, give or take a few barrels throughout the last few years. But do you think that they have to increase in the next 2 quarters?
So I think through the back end of the year, what you're looking at is continued positive growth, modest growth out of the U.S., modest growth out of the Eurozone, modest growth out of China, things moving forward, accommodative monetary policy still in place, encouraging growth, oil demand growth gradually rising. Some of that will feed through to emerging markets by the end of the year. That's where there's the most upside for oil prices, and next year as well. So we see oil prices rising into 2015 and 2016 as the modest growth we see in consuming economies spills over into emerging markets.
Now, tell me what you thought about the recent report from the IEA. They came out with a new investment report, and a very thorough report, one they hadn't done for many, many years, looking for more investment, and particularly from the OPEC countries as well. What was your take on that report?
Well, this is something that we see again and again, which is that you are seeing oil demand rising. That doesn't show a sign of stopping. The oil demand increases in emerging markets, continues to go up, which means you need more oil and you need to invest to get that oil. There's been a lot of discussion and hype around the American shale revolution, but I think that's more an exception than a rule. And at the end of the day, you're going to need to spend more money to get more oil. And even in shale plays in the U.S., over time it's going to become more expensive as you move further and further away from optimal drilling areas, what's known as the pay zone.
Talking about Shell, are we going to see any of it over this part of the world soon? They're all getting excited about will they export it, won't they? And how quickly could they actually deliver that? I mean, this has got to be, Congress have a lot to do. There has to be a new law in place before they do anything.
Well, that's right. And I know we've discussed this before, that the only way you can get the oil exports to happen is if enough lobbying money sort of ends up going to Congress, right? That's what it takes. That's how the system works. If you want to export something, you need money to push that, right? That's how that functions. But at the end of the day, even if the law was changed, the risk in the U.S. really is that you won't export these barrels because the refining is cost competitive with Europe. It's even become cost competitive with Asia. So what you actually would want is to still continue to produce refined product in the U.S. As long as natural gas prices are cheap and that keeps power prices relatively contained, then that means it'll be cheaper in the U.S. to produce petroleum products, and that means you're still going to probably over time have the Gulf Coast in the United States be even more of a critical hub for petroleum products and export of product rather than for export of crude.
So you're not as excited about it as some of the front pages might be, and again, introducing a bit of sort of fear into the market that thousands and millions of barrels are going to be coming from America and flooding the market.
Well, I think it makes for really interesting headlines. But at the end of the day, the financial situation behind it, the economics behind it, really dictate that what we need is the Keystone XL pipeline to get more of the heavier sour bitumen, to get that down, to blend with the WTI, to blend with other light sweet grades of crude. And when you blend that, you'll be able to get better product cuts of distillates. The truth is, if we export light sweet crude, that's stuff that's going to give you a high product cut for gasoline. And outside the U.S., that demand it's nowhere bigger than in the U.S., which is part of the reason we'd want to create oil blends that will give better product cuts of distillate to export diesel.